Emerging markets have been one of the year's biggest stories. The MSCI Emerging Markets Index has outperformed the MSCI World Index over the past year. You can take a look at these two lines, nearly doubling the returns of the developed nations. But can emerging markets keep it going? Well, George Iwanicki is a managing director and global emerging market strategist at JPMorgan Asset Management, which has about $1.2 trillion in assets under management. And he says that strength can largely be sustained. So, George, welcome. It's great to have you here in the studio in person. What are clients saying to you right now in terms of their concerns? I mean, I feel like we can't go more than 10 minutes in the business news industry without talking about China, but there are some real risks of inflation in that country.
There are, and it's not only China. There are selected countries within emerging markets. Even if you have a positive view like we do, you can find selected markets where inflation risks are actually the issue. Probably for 2011, it's already been an issue in China over the past year. Policymakers have been tightening so as to try to rein in some of those inflation pressures.
And we've talked about this in terms of food prices there, real estate prices. The notion that those two markets had asset bubbles is something, that we've been covering. But what else? What are some of the other countries? I know India is another country that many people are very bullish on.
Yes. We're looking at countries to see which are effectively in position in their business cycle to be potentially overheating. And China stands out as one, given the strength of growth that we've seen, frankly, right through the developed world crisis. Other countries, though, that we're focusing on where you have these same potential risks are India, as you mentioned, and Indonesia, which has been more or less a darling market for many emerging market investors, also has, in our view, some inflation risks looking forward.
So when you're looking at sort of a global diversified portfolio in terms of equities, are you saying to clients, pull back on positions in these countries because of a risk of overheating?
We're lighter in several of our top-down informed portfolios. We're lighter in exactly those countries, largely for some of the risks that I just described on inflation. But I would emphasize it's much more of a selected risk in certain markets rather than it being sort of an emerging market-wide problem.
Okay, and let's talk about countries that you think are well positioned. These are Brazil, Russia, which sort of surprises me because the more I read about Russia, I think that the more concerned, just from the outside looking in, that I am about the countries, just their political stability, just their framework, their judicial framework.
I'll put out three. Maybe we'll start with Russia. Russia, interestingly, is a very cheap market. As you point out, there are reasons that it should be cheap. There are corporate governance issues. There are rule of law issues that people will cite. I would highlight, though, it's not only a cheap market, but also the inflation pressures there. For what has historically been a higher inflation country, the upside risks to inflation don't look as dramatic right now, in part because of the big slowdown Russia had in 2008 and early 2009.
Are there particular sectors you avoid in Russia that you think maybe hold more risk?
We're more selective in the energy sector in particular, and for a variety of reasons. One is we know oil prices are very volatile. The second is that is the one sector where there are sometimes corporate governance issues where the government still has stakes, for example, in some of the companies in that industry. So we are sort of selective there.
Now, Brazil is another country that you like, that you think is well positioned to avoid inflation risk. Now, earlier, on one of our earlier shows on Tom Keene, we had one of our Bloomberg reporters on there, Don Capecchi, who just made the case today that there's a serious asset bubble in this country.
Interesting. If there's a bubble in Brazil, it's arguably in the currency. The currency's had a multi-year run, not only because of high interest rates attracting capital, but also because of the offshore oil finds that have created expectations of future growth. But what I would say is local asset prices don't look overshot in Brazil. And secondly, in terms of inflation risk, it doesn't look like an economy that has necessarily reached a degree of overheating that, say, China, India, or Indonesia that I mentioned earlier have reached.
And then very quickly, just touch on Turkey. This is the third country that you like.
I'm not alone, and we're not alone, in liking Turkey within the emerging market space. But I'd make several points about Turkey that I think are positive. The first is...
We have about 10 seconds.
Oh, okay. Positive demographics, positive politics, in my view, and still reasonable valuations on the market, still attractive to us.
All right, Brazil, Russia, Turkey. Thanks so much.